Let's welcome on board the management of CanFin Homes. So we've got on board with us Girish Kousgi, who's the Managing Director and CEO of the company, joining in right here in the studios. Girish, thanks so much for joining in. I'm just looking at the stock price chart of your stock. In the last 10 years, your stock has rewarded in excess of 29 times returns to its shareholders. What a brilliant move this has been. What would you say have been the key achievements and what really could have aided this kind of growth? Because the way a stock price moves is also a reflection of what you are doing at the back end in the company.
Thank you. I think the strategy of CanFin was to grow good, profitable book, to keep the book healthy. And to get this right, I think the company did a lot of good things. Even today, we focus largely on home. Our non-home component is hardly 6%. So 94% is home, including top-up of 5%, which is nothing but home loans. Now we largely operate in affordable space. The kind of properties we fund is residential and commercial. So we don't really do high value. Our ticket size is 18 lakhs. So we choose geographies very well. So if you ask me 3-4 things, what actually helped this company to do well in last 10 years is that one is to get the profile right. 70% of our portfolio comprises of salaried and 30% self-employed. Everyone knows salaried behaves better than self-employed, and therefore we focused on salaried. Second is geography. We largely focus on geographies where we can get salaried customers, and there are certain markets outside salary segment which are predominantly self-employed. There we go by good repayment credit culture so that the risk to that extent is lower. Third, we focused on low ticket size. We don't want to get into high value. If you look at our high value, which is more than 50 lakhs, it's hardly 4% in the entire portfolio. And if you see more than 50 lakhs, majority of it would be from salaried segment. So it's geography, it's the profile, it's the product, which is home loan, and also the kind of variants. Today, when we fund to self-employed, we give loan based on proper assessment, not based on surrogate income. Sure. So all these things, I think, actually helped. Of course, we also priced it differently in different markets to maintain profitability and, of course, managed cost.
Sure.
I think these things.
But the kind of distress that the economy is seeing, and especially the real estate sector, and this is across categories. I'm not talking about the luxury market. It's even the affordable segment, which has totally come to a standstill because of not just the weak economic scenario right now, but also the joblessness and the feel-good factor sort of missing from everyone. Do you really think you'll be able to replicate these kind of growth numbers going forward too? Or what is it at your end that you're doing special to try and lure the customer back to you?
If you look at market, let me talk about affordable, non-affordable.
Sure.
So affordable, the demand is still strong. It's very strong. Within affordable, especially projects have slowed down, which is from developer. Within affordable, non-developer space, which is a large space, because we cater to tier 2, 3 and 4 kind of cities where we have very few projects to fund, and therefore our dependency is more on self-construction, composite loans and ready-made property, either it is first purchase or a resale. Now, in this segment, the demand is quite strong. Now, if you talk about industry as a whole, there's a lot of pain. And it will take at least according to me, next 6 to 8 quarters for this pain to subside and get back to pre-ILFS or maybe pre-Diwan kind of situation. So there's a lot of pain. Having said this, government has taken a lot of initiative. RBI is taking a lot of initiatives to try and revive this industry. Yes, but it takes some time. What has happened is that credit has stopped flowing to developers, some of the big developers, and to most of the HFCs. Now, because of this, HFCs are not able to lend. Now, how will we come over this? We will also have certain challenges, but that is to a smaller extent, because if you look at a portfolio, our non-builder, when I say non-builder,
Sure.
largely focusing on self-construction, composite, plot is about 75%. And we operate in small markets. So we don't see any challenge, at least for next 6 to 8 quarters, for us to maintain a growth rate better than the industry growth rate.
You're looking at a 40,000 crore loan book size by FY22. That's the number you had mentioned earlier. Are you still on track for it? Do you see growth continuing at this rate?
I think for next 2 years, our growth rate would be moderated. I don't think so. We would be growing at that pace, given the situation the market is today. So, industry is expected to grow in the range of 10 to 11%. We would grow far higher than industry growth rate.
Are there any specific geographies as well when it comes to, for example, the housing pockets that you're looking at where you see growth doing better than others?
I wouldn't want to compare, but yes, we are doing well in the geographies where we are present, barring one or two. So as I told you, we choose geographies very, very carefully. For example, you take any big city, within that city, which pocket we need to operate, I think it gets into that minute detail. So largely, South has been good for us.
Exactly.
And North, certain markets, West is good for us.
So would there be a bigger push on the North now? Because you're also looking to expand your network of 200 branches by March. Where are you in that process? How much more are you looking at pushing the network as well going forward?
So we'll keep growing. We'll keep expanding branches in the years to come. By March, we'll be at 200 branches.
Okay.
We will try and grow in all the markets. As I told you, largely we prefer salaried or low risk self-employed markets.
Okay. I wanted to also get in a sense as to what the outlook is on the fundraising plans. I understand that there was a 1,000 crore rupee rights issue, QIP. Can you just tell us about the timeline? Are there any further fundraising plans?
We have planned to raise funds to the extent of about 1,000 crores, 1,000 odd crores. We are trying to time it appropriately. We are hopeful we will do it before end of this financial year.
Okay. Now, she was talking about, the outlook on the real estate sector, the general gloom and doom in the economy. The government has taken certain steps. What more do you think is required?
I think government is doing enough to revive the industry in last 3 to 4 months. But I think more is in store. If you have to get back to those levels which was there 2 years back, I think a little bit more is required. I'm sure government is planning for that.
Any expectation? Any expectation from budget, or what are you expecting?
I think what the industry would expect, I would put it that way. Industry would expect some kind of revival package for the developers.
Okay.
And some kind of scheme where flow of credit happens to the smaller HFCs, because while we talk about few companies doing well in this market as well, but most of the HFCs are not doing well because of the fund constraint. So I think one on the credit flow, and second in terms of some kind of stimulus package to the developers probably would help.
Okay. Fingers crossed on that one. Girish, thanks so much for taking the time out, joining in, and here's wishing you a very happy new year and a prosperous one at that from all of us.
Thank you so much.
Thank you.